Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're cutting through the noise and taking a comprehensive look at Dover's second quarter 2025 earnings conference call. We've really dissected the commentary from CEO Richard Tobin, CFO Chris Wilker, and VP of Investor Relations Jack Dickens. Our goal today, to bring you the essential nuggets, help you understand not just what happened, but really why it matters for Dover's performance and, their future outlook. So let's kick things off with the big picture. The headline numbers for Q2 2025. What was the absolute standout?
Yeah, okay. So what immediately jumps out is Dover's really robust operational performance. They reported exceptionally strong results, and this was largely fueled by stellar production and actually very favorable margin mix. Specifically, adjusted segment EBITDA margins, that key measure of operating profitability, they hit a record, flew past 25%.
Wow, past 25%.
Yeah, and adjusted EPS climbed a significant 16% for the quarter.
16% EPS growth, that's certainly impressive. Did that strength translate into like a strong forward look?
Absolutely. The order trends kept up their positive momentum, up 7% year over year. And this strength clearly gave management confidence. They shared that, the majority of their Q3 revenue is already locked in via backlog. Already in the bag, essentially. Pretty much.
Yeah.
And July orders are tracking exceptionally well. So that strong visibility, it's a powerful indicator.
And that confidence wasn't just talk, was it? They actually put some numbers behind it for the full year.
Precisely. Yeah, they raised their full-year adjusted EPS guidance. The new range is $9.35 to $9.55. At the midpoint, that's a 14% increase for the full year. Pretty clear statement of their optimism, I'd say.
Okay. And cash flow, how did that look?
Equally impressive, really. Year-to-date, free cash flow came in at $261 million. Now, that's a $41 million improvement over the prior year, and it represents about 7% of revenue. Mm-hmm. And they fully expect that cash flow generation to accelerate significantly in the second half. They're maintaining their ambitious 2025 free cash flow guidance, 14% to 16% of revenue.
So, strong earnings, strong orders, strong cash flow. Sounds like a pretty compelling picture overall.
Yeah, that's the summary.
Okay, let's unpack this then. Really get into the specifics of what drove these numbers. Where did we see the wins and, maybe where were the headwinds across their different segments?
Right. And what's fascinating here is how diverse the performance was across the segments. Yet somehow, the overall picture remained strong.
Let's start with engineered products. Revenues there were actually slightly down.
Okay.
Primarily due to lower volumes in vehicle services. But the underlying sentiment, especially in North America, showed marked improvement. They mentioned a book-to-bill ratio above 1.
Which means more orders coming in than going out.
Exactly. Signals future growth. And despite that slight revenue dip, margins for the segment actually increased.
Interesting. How?
It was a direct result of their structural cost management and productivity efforts.
Got it.
Then you have clean energy and fueling. That was a clear growth engine, up 8%.
Strong number. Yeah, propelled by robust shipments and clean energy components, fluid transport, and North American retail fueling software and equipment. Margins here improved by 80 basis points. That's 0.8% benefiting from volume leverage. A higher mix of that below-ground fueling equipment.
Which tends to have better margins.
Right. Typically better margins, specialized nature, long-term service contracts, all that. And benefits from restructuring, too.
So a bit of a mixed bag across those first two, but clear operational leverage shining through. What about imaging and ID? Usually pretty stable, right?
You're spot on. Imaging and ID remain stable. Growth in their core marking and coding business largely offset some timing impacts they saw in textiles. Mm-hmm. But what truly stood out here were the exemplary adjusted EBITDA margins, 28%.
28%.
Yeah. And this wasn't accidental, driven by continuous efforts around cost to serve, rigorous structural cost controls. It really highlights a segment that consistently delivers high profitability.
Okay, moving on.
Let's look at pumps and process solutions. This segment saw a healthy 4% organic increase, fueled by double-digit growth in 3 key areas. Single-use biopharma components.
The hot area.
Definitely. Then thermal connectors for liquid cooling of data centers.
Another one.
And digital controls for midstream natural gas compression. Now, their long-cycle polymer processing equipment business, that was down year over year, as they forecasted. But quoting activity improved, and its book-to-bill was also above 1.
Suggesting a rebound.
Yeah.
Okay.
And the acquisition of Sikora also played a role here, contributing positively to both revenue and margin.
And finally, climate sustainability. That segment touches on a lot of interesting sort of forward-looking areas. What was the story there?
Right. In climate sustainability, revenues were actually down.
Oh.
Yeah, largely due to declines in traditional food retail cases and engineering services. However, and this is crucial, this was more than offset by record quarterly volumes in CO2 systems.
Ah, so a pivot within the segment.
It's exactly. Signals their shift towards more sustainable, higher value solutions. Heat exchangers, another big part of this segment, saw sequential and year-over-year growth, record shipments in North America, and they're actively expanding capacity, specifically targeting that data center demand.
Data centers again?
It's a recurring theme. Now, European heat pump shipments were down slightly, but they expect a positive turn in the second half. And despite the overall revenue dip for the segment, they still posted a 60 basis point margin improvement.
How? Same reasons.
Pretty much. Productivity actions and that higher mix of CO2 systems driving better profitability.
What's fascinating here really is the deliberate shift we're seeing. It's clear they're not just reacting, they're actively shaping their portfolio. Where are they placing their biggest bets for future expansion, these strategic growth platforms?
You absolutely hit on a crucial point there. Management was very clear about significant investments, both organic and inorganic, in key high-priority markets. And these aren't just minor things. These areas now account for 20% of their entire portfolio.
20% already?
Yes. And they're specifically expected to drive double-digit growth and, importantly, attractive margin accretion. They're strategically pruning lower-return businesses and recycling that capital into these areas.
So what are these key areas exactly?
They highlighted clean energy components, single-use biopharma components, CO2 refrigeration systems, and perhaps most notably, inputs into liquid cooling applications for data centers. That includes their large heat exchanger business.
Okay.
They specifically mentioned that thermal connectors for data centers were up a remarkable 50% year to date.
50%, that's huge momentum.
Immense momentum. And what's even more telling, maybe, is that they're aggressively building out capacity. They actually said they are currently overcapacitized in both thermal connectors and heat exchangers for this market.
Overcapacitized, that sounds unusual.
It does sound counterintuitive, but it speaks volumes about their conviction in the long-term growth of data center cooling. They're truly betting big here. They want to be ready.
That proactive approach to capacity building, it really stands out. And speaking of proactively managing cost actions and productivity were a recurring theme. How are they driving those record margins we talked about earlier?
Yeah, that's a critical component of their success story right now.
Yeah.
A meaningful chunk of their margin performance comes directly from rigorous cost containment, productivity actions. They're undertaking significant high ROI organic capital projects. That includes strategic capacity expansions, yes, but also footprint optimizations. Things like consolidating operations under fewer rooftop consolidations.
Taking things leaner.
Exactly. Making the business leaner, more efficient. They expect about $30 million in savings this year from actions taken in prior periods.
Okay, realizing past benefits.
Right. And looking ahead, they anticipate at least another $30 million in savings for 2026 for the projects they're doing now. And they hinted the total could be even larger, potentially continuing into 2027.
So sustained cost savings.
Absolutely. It reflects their ongoing goal to drive, non-revenue profit generation through these fixed cost reduction programs. Basically boosting the bottom line by making their operations inherently more efficient, not just by selling more stuff.
So it's really about making more with less, which, as you said, creates a powerful margin story. And on capital deployment, beyond those organic investments, what else did they discuss? M&A.
Yeah, beyond the internal organic investments, they were also active on the M&A front. They completed two pretty attractive acquisitions in their pumps and process solutions segment in Q2, strategically enhancing that part of the portfolio.
Okay.
And perhaps even more intriguing, they reveal they have close to $400 million in revenue under letter of intent, or LOI.
$400 million under LOI, that's significant.
It is. It signals they have preliminary agreements outlining terms for potential future deals. They noted these are largely proprietary deals, which usually means lower execution risk. It tells us their portfolio transformation is definitely not over yet.
Okay, all of this sounds quite positive, but what about the broader macro picture? Are they acknowledging any headwinds, any economic static, or is it all smooth sailing from here?
They're approaching the second half constructively. That's the word they used. So optimistic, but realistic. They acknowledge what they called macroeconomic noise, but they emphasize that underlying end market demand remains healthy, supported by sustained order rates. So No dramatic slowdown on the horizon from their perspective.
But some pockets of softness.
Exactly. They did point to some specific areas. Traditional refrigeration cases are behind their expectations, and cryogenic components, specifically related to LNG infrastructure.
Right, LNG.
Yeah, those have seen projects push out, delayed due to slower infrastructure builds. They also noted that the biopharma growth rate, remember, it saw some restocking in Q1.
Yeah, a bit of a surge.
Right. That will likely normalize in the second half, which just means the exceptionally high growth from that inventory catch-up will level off. Not that the underlying demand is gone, just normalizing comps.
Okay, makes sense. So what does this all mean for the rest of the year? How do they see these different pieces fitting together?
They anticipate what they termed a mild rotation in the back half.
Mild rotation, meaning?
Meaning some businesses that weren't as strong in the first half are expected to start recovering, while others, like, say, biopharma and those booming thermal connectors, will face tougher comparison periods from last year. This could lead to a mild dilutive effect on consolidated margins overall, but they stressed it wouldn't be dramatic, just a slight mix shift.
Got it. And pricing, competition.
On competitive dynamics and pricing, they feel they are in a very positive position, both on price and total cost. They expect continued margin accretion. They attribute this partly to competing effectively, especially against smaller competitors, which gives them more leverage in managing input costs.
Okay. And any currency impact factored in?
Yeah, for their second half guidance, they're using average year-to-date foreign exchange rates. They did mention, though, if the dollar-euro rate remains stable where it is now, that could actually add about 100 basis points of increased revenue in the back half.
So potentially a nice little tailwind there.
Could be, yeah.
Okay. So for you, the listener, digesting all of this, what really stands out from this deep dive? What should you be paying close attention to as we move forward with Dover?
Well, what's truly fascinating here, I think, is Dover's strategic agility. They're not just, reacting to the market. They're proactively shaping their future. They are aggressively shedding lower return businesses and recycling that capital into these higher margin, high growth areas like data center cooling and biopharma. This deliberate portfolio upgrade, you combine that with a relentless focus on productivity and cost controls. It's clearly driving significant margin expansion. They even stated a goal of around 100 basis points of improvement per year.
Which is structural, not just cyclical.
Exactly. It's structural. And this raises, I think, an important question for you to consider. In an environment with, all this macroeconomic uncertainty, how much value does the market truly place on consistent operational leverage and aggressive fixed cost reduction? Their commitment to these structural cost programs with tens of millions in expected savings rolling forward into 2026, and beyond that, acts as a significant hedge against potential revenue headwinds. It provides a strong floor for profitability, almost regardless of broader market swings.
That balance they're striking, managing some current softness while aggressively investing in these huge long-term secular growth trends like data centers, that seems absolutely key to their strategy. And the active M&A pipeline, especially with that $400 million under LOI, further suggests this portfolio transformation is ongoing.
Absolutely. They're positioning themselves. All right, so let's move to our This Is Not Financial Advice segment. Let's explore an outrageous but plausible trade idea based on today's call.
Okay, let's hear it. Always disclaimer heavy, this part.
Right, very much so. Not financial advice, but consider maybe a long position in Dover. Perhaps using out-of-the-money call options, focusing on a potential re-rating into 2026. The pitch here, the thinking, is that the market might be underestimating the cumulative impact of Dover's multi-year productivity and footprint optimization work.
The stuff we just talked about.
Exactly. Management was, and I quote, crystal clear that the 2026 cost savings target will be at least as good as 2025's $30 million, potentially significantly larger, with benefits even stretching into 2027. Now, combine this tangible non-revenue profit generation, the cost savings, with their aggressive capacity build-out in high-growth, high-margin areas, like those thermal connectors for data centers.
The 50% growers.
Right? Where they're seeing 50% year-to-date growth and are already overcapacitized, ready for the next wave. So the theory is, if the broader industrial market stabilizes, or if the data center build-out just continues its robust pace, the market might look at Dover differently. You've got the structural fixed cost reduction providing a strong foundation. That makes the upside from these high growth platforms even more impactful on the bottom line. It could potentially lead to a significant expansion in their valuation multiple as these projects come fully online and the market gains more visibility.
Interesting angle, focusing on the compounding effect of cost outs plus high margin growth.
That's the idea. Again, not advice, just a thought experiment.
Understood. And that wraps up our deep dive into Dover's Q2 2025 earnings call.
Yeah, I mean, what we saw was a company delivering exceptionally strong operational performance, record margins, raising its full-year EPS guidance, and strategically investing in those high-growth, high-margin platforms, while at the same time relentlessly optimizing its cost structure, their balance sheet strength, active capital deployment. It all underlines a pretty confident outlook, even with some of that broader economic noise.
This conversation, as always, is just the start. We really encourage you to reflect on these insights. Consider how Dover's strategic moves, their bets, align with your own understanding of the market and these sectors. What stood out to you from this deep dive into their numbers and strategy? We genuinely love to hear your thoughts. Until next time, stay well informed and keep digging deeper.